now.
Hey everybody, it's Tom Deutsch. It's August the 6th. I'm here with Scott Forehand. We're going to be doing a debt-free life overview and questions and answer period. I've been with the company about 6 years. I'm a key leader. I'm Director George and Janet Matthews. And just a couple of quick words about Scott before he gets rolling. He's been doing debt-free life the entire time since Symmetry started about a year ago. He's helped over 60 families. He's retired quite a bit of debt, and he's helped his families increase a lot of their potential for retirement. I know we're on a tight timeline tonight, Scott, so hopefully that was enough for you. Take it away, buddy.
Thank you, Dr. Deutschmann. So earlier, if you missed it, we talked a little bit about the CARES Act, a little bit about the Secure Act. You've got other videos that we've got posted, so you can go listen to those if you want. But basically, it's something, those are two things that the federal government has done that have significantly affected the efficacy of this particular type of vehicle, which is a debt-free life campaign. And it's something that makes them work even better than they were 2 months ago or 4 months ago. Anyway, my name is Scott Forehand. Thank you very much for that introduction, Tom. I am Director Janet and George Matthews. They are my coaches, my trainers, my mentors, my friend. And we are here today to talk to you about debt-free life. So let me go ahead and let's get this rolling. So here we go, debt-free life. And obviously they're bowling way up top. Because I hear lots of thunder where I'm at. So, so this is debt-free life. If you're here, you're either an agent looking to get more information about debt-free life, looking to get exposed to it. Perhaps you're one of my clients or somebody else's client who was sent here to learn a little bit more about debt-free life and what it can do and how it would work for you. Or maybe you're just curious. Whatever, however you got here, welcome. So what debt-free life is a play on words. This virtual face-to-face presentation is designed to give you a 30,000-foot view of what debt-free life is and some ideas of how you can utilize it and incorporate it into your long-term financial plans. Also not just to eliminate debt, but also increasing your retirement potential and really just putting you on the straight and narrow to get you to the point where you're spending money more efficiently. So first couple of questions we're asked when we're taught this system is, are you 100% sure you're going to have a great retirement, or do you have some doubt? I don't know anybody that's 100% sure. I don't. And the next question would be is if we could show you a way to get out of debt in 9 years or less, is that something you'd be interested in hearing about? And I don't know anybody that isn't interested in hearing about, if they've got debt, how to get out of debt in less than 9 years. One more thing about that though, what I'm actually finding is that it's not just 9 years, it's actually, it's a decreasing amount of time that you're gonna be in debt. And that'll make more sense a little bit later. But really what we're seeing is it gets you out of debt 15 to 27 years sooner than what you were originally anticipating. And obviously that can be dependent upon your premiums and your current debt load and things like that. But without a doubt, the system works. I was a true skeptic when I first heard about it, and I did a lot of research and turned over a lot of rocks and took a lot of training, and it works. All right. So if you're here, this is me. This is me and my family. This is most Americans. When we first get started in life here, we're taught that it's okay to take on debt. And obviously with the politicians, both sides of the aisle, running away with how much tax they want to charge us, it goes up and up and up. And this is not what the founders of our country had in mind. It was never intended that 76% or 77% of our income was going to be paid on taxes and interest. And it's crazy. And there's a better way. And what we're going to try to do, and what we're going to show you tonight, is how we can increase those four key pieces of how you spend money. We're going to decrease the amount of money you spend on taxes by 25%. We're going to increase the amount of money you save for your retirement by 500%. We're going to increase your lifestyle by 40% and decrease your interest by roughly 40%. The whole idea is that we want to spend money better. We want to spend more money on the things that enrich our lives, which is our lifestyle and our savings for retirement, and less money on things that take away from our spendable income, which would be the interest and the taxes. So when I said a few minutes ago that, that pie graph we just saw was a representation of the typical American, this is also a representation of the typical American. The average American makes $2 million in their lifetime. That number is probably a little bit light. And that's a lot of money. And the problem is not that we don't make enough money. The problem is we don't spend it efficiently. I have a friend of mine, a woman that has worked with my family since I was about 8 years old. And she was a waitress her entire life. And that waitress never made more than $30,000 or $40,000 a year her entire life. She's retired now. She's retired now with 4 pieces of property and nice retirement coming from Social Security and some other things that she did for herself. So in her situation, she did spend money inefficiently. She did not let the debt monster take over her life. Where she went into debt, it was an appropriate debt. It wasn't a debt for that new, whatever extravagant expense you want to name. It was, I went into debt to buy a house. It was an investment, and that's where we want you to be. And that's part of the learning process here. How do you spend money more efficiently? So what we're going to try to do is we're going to try to increase that amount of money you've got at retirement. The average American having only $60,000 in retirement, that's less than 1 year's salary for most people when they're ready to retire. And it's not enough. So really what we're talking about from that previous screen, increasing the amount of retirement you have by 500%. What we're trying to do here is we're trying to get you to the point where you've got $300,000 or more. And pretty much every case I've seen more than that for retirement. And it's a heck of a lot easier to retire with $300,000 in the bank and living off the interest of that than it is to retire with $60,000 in the bank and living off what little interest there is in that, and also having to go into that $60,000 nest egg to actually just make ends meet. So we don't want you to be on that hamster wheel. We want to make sure that you don't have to be on that hamster wheel. You may want to go be a Walmart greeter when you're 65 years old. That's fine, but we want to make it so you don't have to go be a Walmart greeter when you're 65 years old. So moving on. Traditional approaches to getting out of debt. This is things that you're going to hear traditional money managers talk about, traditional debt consolidation experts, traditional credit counselors. They're going to tell you to go work harder, get a second job, spend less money, go eat ramen. That's it. And of those things that they're going to tell you, even refinancing, what is that? So you save a couple of points. You haven't gotten out of your debt. Not really. The only one that really works here with regularity is that debt snowball. And we're going to talk a little bit more about that later, but that's the one thing that we do focus in on in our system here, which is Symmetry Financial Group's debt-free life system, which is a proprietary product. The only place you're going to find it is right here at Symmetry. So make sure you talk to whoever invited you to this to have them help you put a plan in place and get out of debt and then really, really supersize your retirement. So our better way is what we said earlier, get you out of debt in 9 years or less, or 15 to 27 years faster. How do we do it? Well, we make your money work for you. We put you in a situation where you're spending money more efficiently. We're taking away some of the bank's income and giving it to you. And you'll see that in just a second. So when we look at the traditional approach, left side, to our debt-free life approach, right side, this is, we're trying to get you from left to right. We're trying to get you all those increases, the 500%, the 25% reduction in taxes, the 43% increase in your spending money. Think about this for a second. If you've got $1,000 a month left over in your checking account every month right now, okay? If we implement this plan without you doing anything, without you making any more money, without you spending any more money, without you taking out any loans or doing anything. All we're going to do is show you a better way to spend your money. Same amount of money, same amount of debt, same amount of monthly bills. And in that process, we're going to increase your spendable income by 43%. So if you have $1,000 in the bank left over right now, at the end of every month right now, when you execute one of these plans, you're looking at $1,430. And a lot of people I know, $430 a month extra is a big deal. You know, you're no longer scrambling just to keep your Netflix and your Hulu bill going. Now you're ordering pizza 2 or 3 times a week instead of just one. Please don't tell my cardiologist I said that I do that. Thank you. All right. So moving on, if you are interested in finding out about how this works, then you are in the absolute right place. What we're going to do is we're going to reduce, as I've already said, the amount of interest you pay to your lenders. We're going to decrease the amount of debt you have and try to eliminate it in 9 years or less. I've seen it go as fast as 2.3 years. We're going to reduce the taxes you pay over time. That's huge. If you're not paying Uncle Sam, who you paying? It's going right in your pocket. We're going to improve your cash flow. That's that 43% increase that I spoke about in your cash flow situation. And we're going to, I love this one. We're going to allow you to retire with a tax-favored income. What does that really mean? That means we're going to allow you to retire with the most favorable type of taxed income, which is zero. So this is a tax-exempt income, and we'll explain to you how that works in just a minute. So the 80-20 rule. There's when Symmetry was looking at this and when we were developing this program, one of the things we looked at was some of the programs that came before us. This is not a new concept, folks. This has been around for a long time. It uses 2 key financial concepts. One's called infinite banking and one's called debt snowballing, true debt snowballing. So there have been other plans and other systems that came before us, but invariably they all had Achilles heels. They all failed for some reason. And what we did is we analyzed all those other plans and figured out where they all failed. And there's 10 common reasons why each one of those previous plans would fail. And what we did is we took all 10 of those reasons away. And one of the biggest reasons that they all failed is they didn't plan for the unexpected. They assumed that the minute you took one of these policies, one of these solutions out, started one of these plans, that you weren't going to die the next day, or that you weren't going to become injured, disabled, sick, and unable to work the next day. And that's why most of those plans have failed in the past, is they did not plan for the unexpected. So what we do here is you're going to be spending X amount of money, which is, it's going to be a net zero change to you, no more than you're already spending right now. And we're going to be stashing some of that cash in part of this plan that you cannot see. And that's by design. It's still there. It's a true emergency fund. It is not, I need an emergency jet ski, or I need to take that emergency trip to Hawaii. It is a true emergency fund. Use it as such. The roof just got torn off. I need to put a new roof on. My car just dropped the transmission. I need to go buy a new car. That's a true emergency. Maybe my 16-year-old daughter is getting ready to go to school, wants braces. Maybe that's an emergency. I don't know. That's your call. But the point is that we don't want you having easy access to that money. It's there. You can get to it. What we want you to see is the 80%. And that 80% is what's going to be growing, whether you make a payment or not. And that's the beauty of this situation. Once you start it, it goes on automatic pilot. As long as you follow the plan, it's gonna do what we illustrate. If you don't follow the plan, then you're gonna have a different result. So when we look at and compare different types of retirement plans, we talked earlier about a Roth 401k, which is the same thing as a Roth IRA. Not really, but there's a traditional IRA or traditional SEP that we can sometimes put in place on people. And there's some logical reasons why you would want to do those 2 types of financial plans. Most of the reasons why you would want to do them at this point have been taken away. One of the main reasons why you'd want to do a 401k is you're taught, put the money in now, don't pay tax on it. So later on in life, you'll be taking the money out at a lower tax rate. And if you were started a 401k and you were told that, they lied to you. If they said, put the money in now and take it out later because you'll be at a lower tax bracket, that's probably true, but it does not. Being in a lower tax bracket does not mean you're going to pay less tax. If anybody out there thinks that the $2.2 trillion the federal government just spent in this next group of money they're getting ready to spend is going to make taxes go down, you need to rethink your logic, because I would propose that you are incorrect. Taxes aren't doing anything but going to go up over the next 10 years. So get ready for it. So if you're putting money into a 401k, put money into an IRA because you want to defer tax, what you're really saying is, I want to put my money in those retirement vehicles because I don't want to pay the tax now, knowing that you're going to pay an even greater amount of tax on it later. Okay? So make sure you take that into consideration. That's one of the beauties of this plan, is that it's tax exempt. No matter how you cut it, no matter how you take the money out of this thing, you're going to be pulling the money out in a tax exempt manner. So when we compare Roth IRAs, traditional IRAs, tax deferred, and then a tax-free solution, this pie graph that you see here, not pie, this bar graph that you see here uses the same numbers for all three of those computations. It's the same $10,000 investment. It's the same 28-year run. It's the same 7% interest rate average. It's the same 25% tax rate average. And in the end, spending the same amount of money with those variables, 28 years, 7% interest, and 25% tax, the tax-free method hands down outperforms everything else. Because if you're on a tax-deferred method, then as you're growing your nest egg, you're also growing the tax. If you're on a purely tax method, then obviously both of them are growing. So this is just a critical analysis when we compare apples to apples, and this system is amazing, works like a charm. So debt-free life has three significant and separate phases of how we run the plan. The first part of the plan is a maximization phase. And what that is, that's where we are putting your money in the best possible position to maximize the return and get you out of debt the fastest way we can. That means, and it's sometimes it's counterintuitive, there's a very specific order in which you can pay off your debt that's going to give you the best return. There's only one way. And the maximization phase that we use with our software to determine what that way is what we're going to be showing you. Next, accumulation phase. So after your debt is gone, now all we're doing is planning for retirement. So we're going to maximize your elimination of your debt. Then we're going to accumulate all those monies that you've been saving and make them grow for you, make them compound for you, get the dividends, do all that stuff to get you to that third phase, which is the distribution phase. The distribution phase is when you can go out and buy that emergency jet ski, and you can go out and buy that emergency waterfront house in Florida, hopefully away from the hurricanes, if you can find one of them. Or maybe you can have that emergency timeshare that you need down in Aruba. Don't know. But the point is that the distribution phase is where it's your money. You do what you want to do with it. And, this is your retirement. Spend it correctly. It'll last you forever. Spend it crazy. We've all heard those stories about the people that have won the lottery, and then 2 or 3 years later, after they got their millions of dollars, are broke again. All right. So this is one of those things that this is going to teach you, is some discipline, as long as you pay attention. So moving on, I mentioned to you earlier that this is not a new product. This is not, debt-free life is a new product, but the ideas and the concepts behind it are not new. Walt Disney did this when he set up both Disney World and Disneyland. He did not have enough money to do it. The banks would not lend him enough money, but he had a fairly large nest egg. So he was able to take this money, put it into one of these plans, and be able to earn more interest on his money than he was borrowing, using the money that he put into the plan as collateral. Doris Christopher did it with Pampered Chef. Ray Kroc did it with McDonald's. Warren Buffett still does it to this day. So this is not a new concept. Debt-free life is a new plan. And the difference between the plans that came before us and this one is that we saw where they all failed, and we eliminated those potential failure points and incorporated the elimination of those failure points into our program. So I keep saying this, we're going to make you spend money more efficiently. All that means is that we're redirecting money that you are spending inefficiently. Okay. We're going to put that cash value of the plan on autopilot so that it's growing for you without you even thinking about it. We're going to borrow money. We're not going to ever take the principal out. We're only going to borrow money using the money that's in the plan as collateral. There's a reading between the lines. When I'm earning more interest than I'm being charged and I'm borrowing against collateral, that means I don't really ever have to pay back the loan. Yep, I just said that. Okay. We're going to pay off your debts 9 years or less, or as I like to put it, 15 to 27 years early. We're going to repay those loans if need be with additional cash as you're paying back the loan, or the dividend can pay it off for you automatically over time. Future purchases. This is one of the things I'm going to talk about today, and I'm going to illustrate to you exactly how a future purchase in a plan can change your plan for the better. And then that legacy. So one of the things that I like to say here is that we are creating a legacy for your husband, for your wife, for your kids. But if you do this correctly, you're going to create generational wealth. What do I mean? I mean, you're going to set your great grandkids up if you do it correctly. If you pull the money out at the right time, fund a policy on them when they're the right age, and then just move forward. Do it over and over and over and over again. And that's we talked about daisy chain annuity stacking on a couple of videos back. We talk about mortgage chunking. It's the same concept. It's just taking chunks of money out and throwing it and putting it other places to work for you. You can do the same thing with other grandchildren or great grandchildren. So moving on. Symmetry started this program in June of 2019. So we are now in the 13th. We just completed the 13th month. These are some of the earlier on folks that we helped. Those are nice numbers, $84,000, $73,000, $100,000. Those are small debts. Most people, the average American, has at least $250,000 in debt. And what we're going to do is we're going to eliminate that for you. Again, 15 to 27 years later, save you money on taxes, save you money on interest, and allow you to retire with the most possible type of tax favored income, which is the zero tax income when you're ready to retire. So how does it work? Well, first off, you need to understand how you spend money. So let's talk about how you spend money. Right now, you work your job, you make money. That money you deposit into your checking account, your Wells Fargo, Citibank, Navy Federal, whoever you bank with, doesn't really matter. That bank uses your money over and over and over again. The average dollar that you put into your bank account gets lent out 7 times by that bank before you actually use that dollar. So let me ask you this question. Do they give you anything for the use of your money? Some banks I know will give you maybe 0.25% interest. Some banks will say, yeah, put your money with us, and if you keep at least a $2,500 balance, we're not going to charge you to keep your money with us, while they're making money with your money over and over and over again. So none of that's fair. It's the banking industry, though. So we're going to show you a different way. But continuing on with this illustration, so the banks made money with your money 7 times. They've lent it out and made anywhere from 1% to 24% with each dollar that you put in there 7 times. And then all of a sudden that bill comes due. You need to make a car payment. You need to make your house payment. You need to pay your credit card bill, whatever it is. So you tell the bank to pay that debt. You say, all right, bank, I'm writing a paper check. I'm mailing it off. Go ahead and pay this paper check. Or you go into your online bill pay system and say, please pay this debt. In the end, what happens, as that green arrow up top shows you, you've moved your money to them. The bank captured it for a little while, made money with your money, but now your money's gone. And now your money has become their money. And all you have to show for this is that portion of debt is paid off. That's it. Unless you're making a mortgage payment, in which case you might have a little bit more equity. But the point of this matter is this is a very inefficient way to spend money. This is a very inefficient way to manage money, and our system is much better. I would say hands down, our system is better, period. Not just much better, but way better. So here's our method. same money, working your same job, whatever, doing the same thing, getting paid, you're still going to get that paycheck. It's still going to get deposited. Your income is going to get deposited into your checking account. This is where it differs. So in the form of a life insurance premium payment, we're going to take some of that money out of your checking account. How much? I don't know. Depends on what your plan looks like. Okay. But let's assume, just for nice, easy numbers, that we're going to take $100 out and pay $100 into our life insurance account. So we took $100 out of our checking account, paid our life insurance premium, which is actually a whole life insurance policy. So we've made a life insurance payment from our bank. We've taken $100 out of our Wells Fargo, Navy Federal, whoever bank, and moved it into a life insurance policy. This plan, it's got 3 parts, okay? It's all one policy, but it's got 2 specific riders. The first rider that we look at is called a term life rider. And what that is a very inexpensive rider that increases significantly the amount of life insurance coverage you have. What does that mean? I mean, your $100 a month life insurance payment, some of which is paying for your whole life policy, that might provide you a $30,000, $40,000, $50,000 policy. But for 11% more, we're going to increase that 10, maybe 15-fold. So that $50,000 becomes a $700,000 life insurance policy when you combine the whole life with the term life. And there's a reason why we do that. And now we're going to get deep for a second. This is called IRS Tax Code 7702. And that tax code says all monies derived from a life insurance policy is tax exempt. All monies derived is tax exempt. It also says if the cash value of your life insurance policy exceeds the life insurance value of your life insurance policy, then your life insurance policy isn't life insurance. Your life insurance policy is then an investment, specifically called a modified endowment contract. And once that happens, everything becomes taxable. So the reason why we have that very large term life rider is because we want the total amount of life insurance to be much larger, at least initially, than the life insurance value that the policy is going to start with. And this is going to take a couple of years, but eventually the cash value of the plan will exceed that life insurance value, but it's okay. And that's, we plan for it, and I'll show you why in just a second. So the third part of this plan is it's called a paid up addition. It's another type of life insurance. That's all it is. But it is, as the word says, or as the name says, it is paid up. So once you've paid for that life insurance, you never have to pay for it again. So what does that mean? What does that sound like? Once you buy a bar of gold, do you ever have to pay for it again? No. Once you take out $100 cash out of your checking account and put it in your pocket, do you have to pay for that $100 again? No. So what is a paid up addition? It is an investment. It is a permanent investment. Paid up addition is a permanent investment that you do not have to spend any money to maintain, and that will have the same value tomorrow and 10 years from now and 30 years from now that it has today. It is a permanent investment that will never lose value. And as many of you know from your IRAs and your 401ks, the 401k and the IRA is not a permanent investment that will not lose value. Okay. So that's a critical piece of this puzzle, because we're actually using your paid up additions as a place to put money. It's a place to stash cash. How much? Usually somewhere between 62 and 68% of every premium. Another portion of that, about 11%, is what's going to pay your term life. Another portion of that whole life, about 22% is paying your term life. And there's additional cash that shows up in a bucket in that whole life policy that you don't see. This is that 20% I was telling you about. Okay. So we've gone ahead, we've made our money, made the income, deposited into our checking account, paid our $100 premium payment for our life insurance policy, which got split into 3 parts. And now we've moved that circle up into our bank, and we are now making money with our money. We are now lending out our money using our dollars over and over and over again. Okay. So wait a minute. So I paid $100 and I put some money up in there, and I've got 68 bucks in my paid up additions bank. And the rest of that $100 went to pay for my term life rider, the whole life, and the cash value in the whole life policy. Next month, I do it again. Next month, I do it again. Next month, I do it again. And I do it for 10 months in a row. And all of a sudden, my paid up additions, before we even take into consideration the effect of compound interest and the dividend, my paid up addition value is now $680, just making 10 life insurance payments. But now I have $680 I can borrow against. And let's say, you know what? I've got one credit card. I only owe $600 on it. Let's go ahead and pay that credit card off. So that's what you do. You take a loan. You do not pull your cash. You do not pull the principal out. You don't touch the principal ever. You just take a loan. You take a loan against that paid up addition value, $600 in this case. That money gets deposited directly into your normal checking account, your Wells Fargo, Bank of America, whoever. And then you instruct, either with the form of a paper check or maybe a bill pay, whatever you do, you instruct your bank, not your DFL bank, not your private bank, but your commercial bank or whoever you bank with, you instruct them to pay that debt. And then they transmit the money, and now the debt is paid. Credit card's paid off. Let me ask you a quick question. Where's your money? Whose money did you use to pay off that debt? You used the carrier's money to pay off that debt. Where's your money? Your money is still sitting in your DFL bank. And on the 11th month after that debt's paid off, guess what? You're making another payment up in there. You're getting more paid up addition. Your bank loan capacity is growing, and you're also getting compound interest. And the compound interest is on that DFL bank. It's on that paid up addition amount. So even though you took a loan for $600, you had $680 in there. You don't make interest only on the $80. You make interest on all $680 that is still in the bank because you didn't take your money out. You just took a loan. Get it? It's pretty slick. So let's look at some examples about how this thing works. So first off, this is a traditional family. This is a family that I helped back in October of last year. And this particular family, nothing special about them. It's a husband and a wife, both previously married. They both owned other houses. So that's why there's a other property here, and there's a personal residence here. There's a student loan. The wife is a doctoral student getting her PhD. So she's got a lot of student loans out. And then they've just got traditional loans, car loans. Got some tax issues here because the gentleman works as a 1099, and other stuff. This is normal stuff. But because of that student loan, which are vicious, by the way, because of that student loan, this family was going to be out of debt in 40 years at their current rate. That means in 40 years, they would have 2 houses paid off with 100% equity in both houses. They'd have 0 debt, and they'd have 0 retirement. So moving forward, when we look at them, did they have $584,000 worth of debt? Not really. At 767. That's because when you're looking at true debt, you got to take into consideration what the interest is. Okay. So in this scenario, this family had $182,000 of scheduled interest. If they didn't do anything to change anything, they were going to pay back a total of $767,000. $182,000 would have been interest. So what did we do? Well, we executed a plan, got them out of debt in 7.8 years. We eliminated $70,000 in interest. That's not a lot, right? Nope, that is a tremendous amount of money. The reason why is because of the effect of compounding. That $70,000, when you throw that back into the mix, back into their bank, where we're getting that compound interest and we're getting that dividend paid on that on top of the compound interest, then that's why this plan flies the way that it does. And you can see here in this middle column the percentage rate. This is done with our software. This illustrates true debt snowballing. Okay. A lot of people think of debt snowballing. They think of, let's pay off the highest interest rate first and then go to the next one and go to the next one. That is incorrect. That is not the most efficient way to get out of debt. This software computes that. You'll see a lot of these have 0% interest. So they're not paying off the highest interest rates before the lower interest rates. They're doing whatever makes the best sense to get this. See that last column, the roll-up deposit. That's what this game's all about, folks. This is about getting to the point where you've eliminated a debt and we can start having that money come into your bank on top of whatever you're already paying. This is debt snowballing. And now we're using the money you were paying to pay off that debt to come back up into your bank, earn money, pull it back out, pay off the next debt, and you just cycle through it. But each time you cycle through a debt, the amount of money you're spending each month can go up because you're no longer spending $28 a month for that care credit bill. You're no longer spending that additional $65, which comes to $98 roll up on that Virginia state tax bill. That's how this program works. So this is that family. The gentleman that we ran this program on was 36 years old. So they have debt, 40 years of debt. So that's why this plan runs to 40 years. So in this particular instance, at 40 years, they'd be out of debt. They would have paid $182,000 in interest. They would have full equity in 2 properties, and they'd have 0 additional retirement to show for it. On our plan, we're going to get them out of debt in 7.8 years. We're going to save $70,000 in interest. And look at that bottom line. We're going to generate $4.8 million in a retirement income vehicle that is permanent and tax exempt. And in addition to that, we're going to give them one heck of a paid up life insurance policy that's worth just under $1 million, or just over $1 million on top of all that. So for this gentleman to do this plan, it cost him 0. All we did was repurpose the money that he was spending and spent it in a more efficient manner. We are not telling you don't pay your debts. We are not telling you to have your credit score tank. That's not what this is. This is not debt negotiation. You're going to pay off your debt, but we're going to turn debt on its head, and we're going to use the debt and the effect of compound interest that's working against you with debt. We're going to use that money to work for you. That's why this plan works. So for this family to not have done this plan, it would have cost them $4.8 million. 5.9 if you consider the amount of the paid up life insurance policy they're going to have at the end. Here's how it worked. Each one of those yellow rows is a year when at least one debt was paid off. So in this scenario, we repurposed $32,000 of payments, annual payments that they were making. Okay, so that's overpayments that they were making on student loans, mortgages, credit cards, $500 here, $700 there. They had some additional life insurance payments that were being spent on inefficient life insurance policies. They were both contributing to 401ks where they were actually losing money, not gaining money. And they were overfunding them to the point where I think she was paying in 9% into her 401k, but they were only matching her 3%. So she was overfunding 6%. So that's where that $32,000 came from. That's money they were spending every year already. So it's 0 cost to them. Okay. And at the end of the first year, they've paid $32,000. They've got a $1.06 million life insurance policy. They've paid off $14,000 in debt, and they still have $12,000 left over at the end of the first year. Word of warning, the dividend, do not expect to see a large dividend in the first year. It doesn't happen. It takes about 2-3 years before you start seeing a big dividend. Okay, second year, same deal, $32,000, paid off another $15,000 in debt. Now we've got $40,000 sitting in our account. Third year, paid in another $32,000, paid off another $58,000 in debt, and we've still got almost $30,000 sitting in our account. Fourth year, another 32 grand. We didn't pay off any debt because the next smallest debt, we've got a student loan, a house, and another house. None of them were small enough to pay off in 1 year. So in that case, all we did was grow. So look at this. We paid in $32,000. We started with 29, and now we're at 91. Where's that money coming from? That's coming from the interest, the guaranteed interest. It's coming from the dividend. Remember I told you year 2, year 3 is when you're going to see the dividend start running. And it also comes from the snowball. And then it grows faster and faster and faster. And then finally, we're out of debt, 7.8 years. Now look at this. Full debt snowball is rolling. Debt snowball plus a base premium, we're growing $100,000 a year. Crazy. Now we reach our first problem. Our first problem is this right here. Year 11. In year 11, we've got too much money. We've got too much money stashed in our plan. What do? You start a second plan. You bite the bullet and put it into a savings account and only earn 2% interest, or you take the money and go buy an annuity with it, go chunk your daughter's mortgage, start paying off your daughter's mortgage, whatever. But the point is, our system illustrates this savings balance column as a 2% return. Don't do that. Put it somewhere else. Make it work for you. Okay. So this gentleman wanted to retire. He said, I'm working till I'm 80, 75 years old. So we have him going to 75. But I said, wait a minute. What about if we get you retired at 60? So at 60 years old, oh yeah, one thing. These plans are written with what's called a flexible paid up addition plan. Flexible means you don't have to pay it. So if you want to stop, you can stop. Okay. As long as there's enough cash in here, you'll convert it, and then you don't have to make more premium payments. So you can stop. We illustrated this just because he said he wanted to retire. But in this situation, at age 60, right here, he will have $2.2 million in his account. I don't know many people that can't retire with $2.2 million in the account. That's the equivalent of $3.3 million taxed, because remember, that $2.2 million is tax exempt. All right. So a couple other things I want to show you. What about if you don't have a house? What about if you just got some, some small debts? Well, this is a student that I worked with last October. She has a lot of debt as a student. She has $85,000 in debt, and that's because she's got a lot of student loans. But look at this. This is what I was saying earlier. Student loans they're evil. And she's going to pay back $91,000 in interest off of only $85,000 in principal owed amount. That's because of the effect of student loans and the fact that you can amortize them over 40 years. It's wrong. So what we did for her, she's paying back more interest than she's got in principal owed. She's actually got $177,000 in debt. That's not a lot, but we can still work on it. And I understand this woman is a student. She's a full-time college student. She works part-time as a waitress. So we have a plan for her. It's $350 a month, 9.7 years. So we're going to save her a significant amount of interest. How much? $64,000. We're saving almost over two-thirds the amount of interest she's going to be paying over time. We're saving it. So does she have any equity? No. But what she does have is in 40 years, she has $603,000. She is 23 years old, folks. So she will retire with $603,000 in the bank at age 63. But moreover, she didn't have to pay in for that long. We've got her retiring at 55. So at 55 years old, she stops paying into the plan. And she could stop right then and retire if she wanted to. She'll have $410,000 in the bank. This is assuming that she never graduates from college, never gets her master's, never gets a job making more than what she's making right now as a waitress. Is that going to happen? Probably not. I hope not. So this is debt-free life. This is how it works. It is not magic. It is just math. And the math works, and the math is contracted, meaning that once you sign up for one of these plans, it's a contract, which is a critical thing here. Why? Well, the fact that this is a contract means that IRS regulations don't apply, banking law doesn't apply, and you cannot be sued. So if you run into your neighbor's car and they want to sue you for everything that you own, they cannot sue you for a life insurance policy. So if you've got money stashed in a life insurance policy, it's safe. It is tort proof. Okay. So let's move on. I want to go ahead and talk a little bit about how working within the confines of a debt-free life plan, there's some things that happen that don't make sense. And one of them is you would think that if you added more debt, that the debt would make you take longer to get out of debt. you would think that if you added more debt that you wouldn't have as much money at retirement. These are things that would normal people would think. And that's what I thought too. But I had this case recently, and I'm going to show it to you now. So this is a client of mine that we just placed about 2 weeks ago. And in her original plan back in May, when we made her application, look at her debt. She's got a lot of debt, but most of it's student loans. Again, evil student loans and a house. So she doesn't have a whole lot of debt. She's got $190,000, almost 120's interest. So this is her true debt, what it really looks like. And what we did was put a basic plan in place so that she'll have, we'll be able to eliminate some of that debt, some of that interest, be able to create a larger retirement for her, get her out of debt 12.7 years as opposed to 40 years. This was the original plan. So the original plan is pretty strong, right? So what happened is this. This is so cool. And there's a concept that we use here. These plans work for everybody. And the more debts, plural, that you have, the better it works for you. So in this case, this woman added a singular debt. She added a water softening system, cost her about $6,000, $131 a month. And she added that back in June. So she's added one debt. So when we went back in, same plan, same premium, but we reran the numbers and we let the system work its magic to determine what the best way to pay off this debt was. And we went from that debt load, it's about the same as last time, a little bit more. Remember, how many years was it? 12.7 years? Well, boom. So this is the part that is really, really hard to grasp. When you execute these plans, we know that things are going to happen. Life is going to happen. Things are going to change. It is okay. If you need to go out and buy a new car, do it. If you need to put a roof on your house, do it. If you need to buy a water softening system, do it. Add the debt back into your plan, however, because as soon as you add it back into the plan, that's what happens. You go from 12.6 to 10.4 years simply by paying more money, adding one debt. One more thing I want to show you, and this is what really, really made me crazy. At the end of her 30-year run with the original plan, she'll have $452,000. At the end of this run, $635,000, $180,000 more, simply by adding one debt, $131 a month, and having that debt get paid off, and having that affect the snowball. It's crazy, folks, but it's math, and it works, and it does exactly what it's supposed to do. So what I would say to you, if you're my client, go out there, spend the money. Don't spend it on things you don't need, but spend the money and add it back into your plan. It'll make your plan work a heck of a lot better for you. So here's how it worked. Here's the numbers. So the original plan, 29.6 years. Added $1,600 in total debt. It was $5,800, but that 2 months had gone by, so some of those debts have been paid down. So we saved 24.4% additional interest. We got them out of debt 18.11% faster. We created significantly more liquidity. It's crazy. So that's it. Where are we at, Tom? Oh, good. We're right on track. All right. So at this point, I'm going to see if there's any questions in the chat. Are you going to post this to YouTube? Yes, at some point. If anybody has any questions right now, let's go ahead and hear them.
I have a question.
Anna Maria.
How are you?
Good. How are you?
Good. Here's a question. I can hear someone saying this. I have a young man who I just did a report for. First of all, he says, I don't think you can find it, but of course the report did. But he is truly petrified to do anything with his 401k. That's the only place that he has any kind of savings.
Uh-huh.
So how do you answer a question like, well, what do I do? Do I stop paying into the 401k? Do I liquidate the 401k?
Right.
What are the ramifications of that?
So first off, I would not recommend liquidating it, although one of my clients just did. She pulled all 35,000 out. So it depends on how much money he's got in there. I wouldn't liquidate it. I would look at what their match is. And if there's a difference in what he's putting in versus what they're matching, I would definitely take the difference because it's going to work better for him in this plan. If you illustrate the performance of a 401k versus one of these plans, 17 years out of 20 years, this plan is going to outperform a 401k. And if you look at the numbers at the end of that 20-year run, this plan is going to be significantly larger than that 401k. And when you start taking out the taxes that you're going to be paying in that 401k, this plan way, way, way outshines the other one. So there is no way that you can illustrate a 401k that's going to outperform this vehicle unless you sit there and you're a day trader and that's all you do. And there's not many people that do that even successfully. So for me, the question is always this: well, all right, how's your 401k doing? How much have you lost? Okay. So, because everybody, if you had a 401k money at the beginning of the year, you're still down about 5 or 6%.
Okay, awesome. Thank you so much.
Yep. All right. Anybody else?
Scott, I had something I wanted to ask. I've been doing quite a few of these, and I like the way that you rephrase how quickly we get out of debt. I consistently see that we're at least cutting it in half, if not by 2/3.
Yep.
And I'm talking about people that don't have mortgages but have like student loans and other loans like that. So for my son, for example, only 10 years of student debt, but now it's down to 3.
Sure.
So is that a pattern that you see as well?
So for mortgage only people, yeah, I'm seeing about a 15-year faster if it's a recent mortgage. And then also depends on other things, because we're not, it's not just debts that where we're getting the money from. We're getting the money from 401k overfunding, and we're getting the money from I'm not going to go to Starbucks 5 days a week this week. I'm going to stop and I'm going to go to Starbucks 1 day a week, and maybe we're changing our spending habits a little bit as well.
Okay. I just wanted to see if that made sense to you from your perspective.
All right. Excellent.
Okay.
All right, Taylin, you've been here a couple weeks. You got any questions?
No, I'm good. Thanks.
Okay.
I just liked hearing it again because each time you get something different.
Okay. All right.
Wait, did she just volunteer to do this in 2 weeks? I thought I heard that in there somewhere.
No, Tom, you're still on the hook.
Okay.
Tom, I'll be here to support you. Okay.
You always do, and that's appreciated.
Okay. All right. So one last call for questions. It looks like I've got nothing in the chat window, and
so let me take a moment before you close it down and just say something that I told my team today. In order to do these, you've got to go through the training, the DFL training, and if you're new, we want you to get good at mortgage protection and funeral and final expense coverage first, because that opens up the door. But if you find one, reach up to your upline who's probably already been through the DFL training. They would gladly help you with the case and work out some sort of shared compensation on it. You don't have to be certified in this to get appointed with the different carriers that we use. I mean, most of us are already appointed with Foresters, for example, but you don't have to be a certified DFL to get a Lafayette or a Mutual Trust Life appointment. And I've got several people on my team that keep asking me, how do I get involved with this? And I say, we can work it together, and it's a great way for you to learn. Yep. But before you can do it, you need to go through the certification. We don't want you to, this is a shiny penny, and I've gone after many shiny pennies in the last 6 years, which has derailed me from the main thing is help a family, earn their trust by helping the family, and then work on some of these advanced concepts that we do. Scott, I just wanted to close out with that because brand new people are running into opportunities and they don't know what to do with this. So it's ask up, and anybody above, in your upline would gladly help you go through a case.
Yep.
So,
Excellent.
I have a question.
and with that, last call for questions.
Yes, I have a question.
All
Who's
right.
that?
Hey, Scott, it's Artie. How are you doing today? Artie Richard.
Mr. Richard, how
Yes,
are you,
I'm
sir?
part of Mike and Christine Wright team.
So what I heard you say, Artie, is you're on Mike and Christine Reif's team. Is that correct?
That's correct.
Okay. We're getting a little bit of a reverb. It looks like
got
you're
it.
on here twice.
I got it.
Okay.
Yeah, I do have two screens out. Can you hear me? I just want to ask a quick question.
Artie, I can barely hear you, sir.
Okay. Let me plug in. Is that better?
Yes.
Just a minute.
Perfect.
I see the problem, Scott. I'm sorry.
No apologies necessary. I'm excited to hear your question, sir.
Okay, my question is, my wife had a 401k from a past employer,
Sure.
and they had to move the funds. I moved out about $35,000 out of it because couldn't leave the funds in there. I put $10,000 in an annuity and still have about $20-something thousand dollars. Just trying to decide on what to do with, whether to put that into the annuity also, or I wanted to ask, would it make sense if we did something like this, did a debt-free life plan with that $20,000?
Well, yeah, but don't forget you're gonna have. Is your wife of retirement age?
No,
Okay.
she's 50 years old.
So you can take a loan right now because of the CARES Act. You can take a loan against a 401k. As long as you can prove hardship, but they're not really going back and checking your proof. So you could actually take a loan out of that 401k, start a DFL with it, let it sit up there, and you don't have to pay that loan back for 3 years. So, and it's at 0%. So you take the loan, put it up into your DFL, let the DFL run, pull it out in 3 years, pay back the loan, and you've got the money sitting in two places. And that's a good option to do with it, and that there won't be a taxable event. Talk to your CPA, but there shouldn't be a taxable event in that scenario. Or if you're just trying to close out the 401.
Yeah, that's where we're at with it. I was about to say that we're closing it out. I'm sorry.
Yep. So you can take it right now without. I think you can take it out right now if it's a COVID hardship without tax.
It is.
Yeah.
We're already pulled it out.
Penalty. So check with your CPA. But that's what I would do. And even if you ended up having to bite the bullet and paying the $2,000 or $4,000 tax on it, there's no penalty right now. So that's a significant savings to be able to access 401k money right now. So and then take it and start your DFL. One point of caution on starting your DFLs with lump sums or 1035s. 1035, you don't have a choice because you're going to have to roll it from one life insurance account to another. But if you had the option to either put in a lump sum and have that on the illustration or not have it on the illustration, on the carrier's illustration, your plan, as long as you make enough room by increasing the size of that term policy that we talked about earlier, your plan will actually work better without putting in the lump sum. And then go put the lump sum anyway. Just make enough room in your PUA that you can add the lump sum.
Okay. In other words, to start it without putting in the lump sum, and then start making the monthly premiums with some of that money. Could we do it that way? Just taking.
If you want, but all I'm saying is your plan will illustrate better. The numbers will look better, and the plan will perform better if you don't schedule a lump sum premium on the application. And the reason why is because that lump sum premium is going to take away from the amount of PUA you can put in later on. So you want to maximize that PUA bank capacity, the amount of money both that you can put in every year and the amount that you can take out every year. You want to maximize that number. And if you schedule a single premium lump sum infusion of cash on day one, it's going to affect your PUA bank capacity in a negative manner. So
Okay,
do it,
understand.
put it in on day one. Just don't tell them you're doing it in the very beginning. It'll
Okay.
work out better for you. And just, you can run the numbers and you'll see what I'm talking about.
Okay. Okay.
All right.
All right. Thank you.
Very good. Thanks, Artie.
I've seen a couple people unmute themselves while you and Artie were talking, Kevin and Nancy in particular. Did you guys have any questions, or was that just to say goodbye?
I actually had a question. I'm not quite sure I can communicate it properly, so bear with me. I know back when you were talking about the savings balance at some point becomes higher and it looks like an investment, and in order for it not to be a MEC, you have to take it out and put it in an annuity or create a new
No.
bank.
You don't have to take it out. All I'm saying is, because once it becomes a MEC, it's a MEC, right? So if it exceeds the MEC number, it's a MEC. You're stuck. Okay. All I'm saying is, you want to, you have that money that's going into the savings column that you need to do something with, and you can get a better than 2% return, which that savings column is only illustrated in our software as a 2% return. You should go start another bank with it.
So
Okay, so you take that money out and do something else with it, and this policy stays active and continues to grow.
Sure. So make sure you understand the illustration software. That illustration software, when there shows money in that savings balance, it's not that the money's in your bank, because it's not. It never made it into your bank because your bank was already at capacity. Okay. That's money that you had left over that you want to put in your bank, but you can't. So what that does, and this is where one of our strategies is, you got a husband and a wife, or you got a father and a son, you got a mother and a daughter, whatever, you start a pre-bank, which is nothing more than a fully underwritten term policy with the carrier. And that way, when the time comes, you just flip the switch, do a conversion from term life to whole life, and now you got another bank already set up and running. Then you start, instead of putting that $8,000 or $10,000 that's in that savings column into a savings account earning 2%, you now put it into another bank earning 4% plus a dividend or more.
Okay.
Does that make sense?
Can I add one
Go ahead, Tom.
thing? Actually, the family I was with earlier today, this was a point that took a little while for them to understand why we need a savings account. And the best way to think about it is this. So for example, they're putting $500 a month in. Okay. And we're scaling the bank, their bank, to be perfectly efficient to use that. They're going to retire enough debt within 2 years that's going to be another $500 in debt snowball that they're adding in. And there's no room in that bank for it without it becoming a MEC. And they said, well, why don't we just make it bigger? And I said, well, then it's inefficient. So we're making this first bank is designed to get you out of debt. Then when your debt snowball gets too big, we set up a bigger second bank. And if you look at any of those reports, you'll see the money in that savings account begins to really outpace the money that's in the life insurance policy. So it's a bigger bank. That's your retirement bank. So when he's talking about you can't put any more money in, it's because the debt snowball has gotten so big, there's no more room for it in your first bank. It's why we need to set up a second savings account. And I told them they're a little bit skittish. So I said, you can put it anywhere you want. We illustrate 2%, which is like, I don't know, a really good CD, if that's what you want to do. And but I know by year two, they're going to love this enough that they're going to open up a second bank on the wife. So
and then anyway, you're going after the kids when they turn 18.
Yeah. So hopefully that helped a little bit there too, because I was struggling with that today, explaining it to my client.
Thank you.
You guys hear my attack chihuahuas going off in the background.
Yo quiero Taco Bell.
Yeah, right. All right. Tracy asked a question. I just put my email address up there. Tracy, if you want to ask me, you can certainly email me anytime. I'll be happy to answer.
No worries. Thank you.
All right. So without further ado, I guess we're about there. Oh, I got time for one more if anybody's got anything else.
I got my question if you want to take it.
Oh, go ahead. Hit it.
Okay. Name's Tracy. I'm on board. I just passed my exam yesterday, but my question, thank you. I resigned in June from a company, and I took my 401k and I took 39% out and rolled over the rest into an IRA. I'm 60 years old.
Okay.
You are talking about no penalty by taking a hardship.
Yeah.
Well, they hit me with the tax. I think I'm at that point where I can cancel the distribution. If I can, how do I go about getting in on the hardship?
Call your CPA.
Okay, gotcha. Good enough. I like that answer.
Yeah.
Okay, no worries.
Right.
I appreciate it.
Very good. All right, Tracy.
Hey,
We appreciate you.
All right, we'll be back here in 2 weeks with Tommy D, and that's it. We'll be Jamie McCrae will be starting up at 7 o'clock. If any of the agents here want to attend the annuity advanced market training.
Scott, drive safe tonight when you're delivering your policies, and thank
yeah.
you so much for your time tonight. Appreciate
All right,
it.
have a good night,
Scott.
everybody.
Good night.
Bye.
Thank you.
Do we have the address, Jamie?